UK unemployment data was seen as unchanged today, remaining at 7.8%. Last week, Mark Carney acted to tie interest rates to unemployment, stating that the central bank would not raise rates until unemployment fell to 7%. But what does all of this mean for the UK economy? On the phone with me now is Simon Smith of FX Pro. Simon, firstly, can you please expand on this interest rate unemployment relationship for us and Carney's thought process here?
In terms of the relationship between unemployment and inflation, there's thought to be an inverse relationship, so fall in unemployment putting upward pressure on inflation, sometimes referred to as the Phillips curve. Now, this was a big thing in the 70s. It sort of died away more in recent decades. So it's interesting that they chose unemployment. So I'm not necessarily thinking that they think there is a strong relationship back with unemployment, and that will prove inflationary. But what I think is more important that in terms of his thought process, that he wants to put an anchor point, so an assurance linking it to an economic variable that rates will remain low until the labour market has improved. So it's just putting that anchor point and not wanting to link low rates to a sort of specified period in time.
There has been some speculation that UK unemployment could hit that 7% target earlier than anticipated. Would you agree, particularly given today's stagnated figure, or does this whole stance have the potential to descend into an inflation target scenario?
Well, it's difficult. I mean, because unemployment itself is, quite a difficult thing to forecast. And one of the reasons why, if you contrast with the US, we still haven't reached the peak in employment, even 5-6 years after the start of the crisis. The UK labour market has held up relatively well, so employment only fell, less than 2% from the pre-crisis peak. The story behind that is productivity has been very weak, so there's been labour hoarding, so people in work are actually sort of not necessarily doing a huge amount of work, if that makes sense. So we could see the situation where unemployment improves, but that's simply because productivity is weak, and that's one of the discussions that went on in the minutes that are released today as well. So, as they say, it's a threshold. It's not a target. So it doesn't mean that when unemployment hits that 7% level, that automatically rates would rise. So, all in all, I think it's more. We are likely to move lower. I'm not sure we're going to move lower at the speed perhaps anticipated, but also I think it's more likely that inflation could prove more problematic in terms of them having to probably move earlier because of inflation rather than the unemployment numbers.
Today, as you mentioned, also saw the release of the central bank's meeting minutes. Ross Walker of RBS has described the split in the MPC over keeping interest rates low as healthy. But with forward guidance such a strong part of new BOE Governor Mark Carney's strategy, how does this bode for policy moving forward? Or are these divisions within the committee overplayed, do you think?
I think on the forward guidance, the divisions were very marginal. There's only one dissent, but actually, when you read the minutes, he didn't say, well, actually, I don't agree with forward guidance. It was quite a technical thing, whereas, the one member, Martin Wheel, wanted a shorter horizon on the inflation knockout. So it's quite a technical little thing that he was against. So in all, I would say the divisions on that were very minor. There still seems to be a wider division on the expectations or potential for further quantitative easing. So there's still some members who were sort of holding back from voting, as they were early in the year, from more QE, just to see how this forward guidance strategy was borne out. So even with the better numbers we have seen, I think the divisions are more actually on the potential for more QE rather than on the forward guidance, where, as I said, it seemed to be a very small technical point that the one member voted against it for.
And lastly then, sterling watchers will be monitoring the UK currency closely for market response on today's data. What can we expect from the pound, do you think?
Well, today the reaction was interesting because even though the headline unemployment rate was as expected at 7.8, I think one or two of the other numbers within the release, such as the claimant count, was better than expected. So that explained the bounce nearly 0.5% higher on sterling to just below the 155 area. So we've come back, and so I think on second glance, investors have sort of played down these figures a bit. Sterling has been helped by the better data, so I think that will continue support. It's still obviously, the dollar is on the other side, and the the tapering likelihood, which is still in the balance for September, is going to decide the direction. So I think I see sterling moving lower, but only modestly so, perhaps back towards the 153 level over the coming weeks.
Many thanks, Simon. Coming up on Dukascopy TV today, we'll be looking at Finland and Detroit, as well as a look at currency pair performance in another Targets in Focus interview. Don't go away.